Hi, this is Jeff Barton. Welcome to the Mortgage Minute. We update you as to what's happening in the mortgage market as well as the real estate market, both nationally and some of the local markets where the radio station plays. But this is obviously on LinkedIn and Facebook and Instagram. So if you're watching this, you can catch us at themortgagevoice.com, and that's on YouTube. And you can go to Jeff Barton, The Mortgage Voice, and catch all these different shows that we put on each and every week, kind of update you as to what's happening both locally and nationally in the mortgage market. Let's get right to it. 5.4% is the 30-year fixed, 4.78 is the 15-year, 5.12 is FHA, 4.60 is the jumbo, and 4.57 is the 5/1 ARM. The ARM products are really staging a bit of a comeback. Let me just look that up. Oh yeah, ARM products are up 14%. One of the reasons why is because, look, if you're into a house or if you're into a property and you're going to get out of that probably within 5 or 7 years, an ARM product is really a lot better than paying the full price on the loan for the 30-year. As I said, 4.57 for the ARM product and 5.4% for the 30-year fix. You can see that there's almost a 1% difference. So if you're doing a short-term loan like between 5 and 7 years, it might make sense to go that direction. Okay, so a couple other things happening. Mortgage applications are up 2 weeks in a row. And that's based on purchases. Purchases obviously are driving the market. The refi business is off 32% this week from a year ago, and that's not a good sign for the lending business entirely. We've seen a bunch of layoffs from any number of different companies, as well as some of the companies out there are also laying off staff. The iBuying business is really in the tank, although we see Rocket and UWM posting pretty good profits in the first quarter, $1 billion for Rocket and $895 million for UWM. I don't know whether that's a holdover or whether that's just that they're killing it out there in whatever market there is available. I do know that both of those platforms are easy, so if you're in the mortgage brokering world, you're probably going to go to one of those two companies most of the time, just because it's ease of use, and that is driving it. Okay, so there's so much volatility going on in the marketplace in terms of what are the Fed's doing. As everybody knows, the Fed increased rates by a half a point, and that, of course, affects short-term lending, overnight window stuff that banks have to borrow from each other in order to maintain their liquidity requirements by the Fed. But that in turn has a tangential, push on mortgage rates, and we've seen mortgage rates rise 3 points this year, which is really an astounding number. Something that we had seen coming for some time, but hadn't really experienced it because of COVID, and COVID really drove the bus of the last 18 months to 2 years. Really, just recently, we've seen the Fed obviously raise their prices. That's going to continue. Everybody knows that. We're probably going to see a couple more half-point raises in the Fed rate, and that in turn, as I said, tangentially will affect mortgage interest rates. The mortgage rates are obviously not good and not going to be good, and we're probably going to see 6.5% by the end of the year. So what does this mean to you? You're out there, you've got a 3% mortgage, you've got to take some money out of your house, you got to do some things around the house, either to fix it up to sell or just to fix it up, or you need medical expenses, or you need that nest egg. So what do you do? Now, we've talked about on the radio show the last couple of weeks about how either a HELOC or a second might be the answer. Certainly leaving that 3% loan or that 3.5% loan where it is probably a good thing. But this also tightens housing market. Now, the housing market itself, what is happening there? Let me just give you a brief example. A couple of the top markets in the country. The inventory in April this year is up in a bunch of different places: Georgia, Jacksonville, Memphis, Nashville, North Texas, Portland, and Santa Clara, but it's down in a bunch of other places: Denver, Las Vegas, the northwest of the country, and San Diego. All of these say that, even with rising interest rates, the properties available on market right now are not that great, and it's not uniform, as is the bubble, the prices and where the prices are going and what they have been. We've seen 20% increase in prices over the last 12 months nationally. So what are we going to see in the next 12 months? Well, there's that whispering talk of bubble, and how does that affect you? Now, for those people who are wondering whatever happened to that COVID inventory, well, the Fed has, not the Fed, but the FHA has said you can forget about it. Investors will not be allowed to get in there and buy these houses up and rent them out, which is what happened the last time. It's unsure as to exactly what FHA is going to do with those properties, whether they're going to hold them up for auction and make sure that only people who are going to live there, or put a restriction on the purchase. We're not quite sure either, but there is a sizable inventory of these properties that are being foreclosed on. Like the last time, the general public is not going to be in on the good deal. By the time they reach the market, it's probably already going to be second, third sale. Anyway, I'm Jeff Barton. Thanks very much for listening, and we'll see you next time.